Good morning and welcome to TOI Japan Market Radio, coming to you from Tokyo on Sunday, March 8, 2026. I'm your host, and today we're bringing you a brief on what global investors need to know about Japanese markets, though I should mention right away that markets here were actually closed today for a holiday. Joining me as always is our portfolio manager who focuses on Japanese equities and macro. Thanks for being here.
Thanks for having me. So yes, no trading today in Tokyo, but that doesn't mean there's nothing to talk about. We've had some important developments in the financial sector and geopolitical space that will likely set the tone when markets reopen tomorrow. The key themes I'm watching are foreign institutional flows into Japanese financials, some stock-specific pressure on major brokerages, and the broader US-China trade tension narrative that continues to ripple through the region.
Let's start with the financial sector then. We saw some interesting positioning news out of one of the major French asset managers. Natixis Advisors has been accumulating shares in Mitsubishi UFJ Financial Group. Can you walk us through what happened there and why it matters?
Sure. Natixis Advisors, which is the asset management arm of the French bank Natixis, has acquired over 1.7 million shares of MUFG, Japan's largest banking group by total assets. Now this isn't a huge headline-grabbing transaction in absolute terms, but the signal it sends is meaningful. It shows that a sophisticated foreign institutional manager is increasing exposure to Japanese mega banks at current valuations. MUFG is systemically important to the Japanese economy and the entire financial system, so when you see foreign managers building positions, it's generally a vote of confidence in both the bank itself and the broader Japanese financial sector.
And from a market impact perspective, what should investors be watching?
For equities, this is modestly constructive. MUFG is a core Nikkei 225 constituent, and foreign accumulation typically provides technical support for the stock. More importantly, if this signals a broader rotation by foreign investors into Japanese financials or value stocks generally, it could attract additional index flows and provide leadership for the TOPIX, especially the financial sub-index. On the yen side, there's minimal direct impact from a single equity transaction, but persistent foreign inflows into Japanese equities over time do provide structural support for the yen. And as far as JGBs are concerned, this is purely an equity story with no material implications for government bond yields.
So a constructive signal overall. Meanwhile, in corporate news, we also saw some price pressure on Nomura Holdings earlier this week. The stock hit a day low around 1,282 Japanese yen per share. What's behind that move?
Nomura is Japan's largest investment bank and really a bellwether for the health of the domestic banking and securities sector. The stock saw selling pressure that took it down to that 1,282 Japanese yen level, though I should note that the detail we have suggests this may be more routine daily volatility rather than a major fundamental shift. That said, Nomura's stock performance does tend to reflect broader market sentiment toward Japan's financial system and economic outlook, given its role in capital markets, M&A advisory, and wealth management. So when you see weakness in Nomura, it can signal either company-specific headwinds or broader concerns about financial sector stress.
And how does that feed through to the broader market indices and other asset classes?
For equities, downward pressure on Nomura can weigh on both the Nikkei and TOPIX, particularly because the financial sub-index is heavily weighted toward banks and brokerages. If the decline reflects a broader risk-off tone, you could see spillover into other cyclical sectors as well. On the yen, financial sector weakness is typically modestly yen negative if it reflects concerns about capital outflows or reduced financial market activity, though in isolation the impact would be limited. For JGBs, if the selling in Nomura reflects wider economic concerns rather than just company-specific issues, you might see yields compress as investors seek safe haven duration. But financial sector stress alone doesn't usually have a big direct impact on government bond markets.
Understood. Shifting to the geopolitical front now, we're continuing to see headlines around US-China trade tensions, and this week China signaled that direct talks with the US are vital as the Trump administration targets Beijing's key partners. This feels like it has real implications for Japan.
Absolutely. What's happening here is that the US appears to be pursuing a strategy to isolate China by applying pressure on its key international partners and trade relationships. At the same time, China is signaling openness to bilateral negotiations to try to de-escalate the situation. For Japan, this is particularly important because Japan sits right at the center of US-China strategic competition. Japan is a major US ally with deep security ties, but it also has very significant trade and economic linkages with China. So Japan is in a position where it could face pressure from the US to choose sides or limit certain economic relationships with Beijing.
Can you give us some concrete examples of what that pressure might look like?
Sure. We could see the US push Japan to further strengthen semiconductor and tech supply chain decoupling from China. There might be pressure on Japanese companies to restrict or scale back their operations in China, particularly in sensitive technology sectors. There are also regional security implications given the broader US-China strategic rivalry in the Indo-Pacific. And there's always the risk that Japan gets caught in tit-for-tat trade measures between the two superpowers, which could impact Japanese exporters in both directions.
So how should investors be thinking about the market impact of this dynamic?
For Japanese equities, the impact is mixed. On the negative side, exporters in sectors like automotive, semiconductors, and electronics face uncertainty around China demand and potential supply chain disruption. On the positive side, defense and security-linked sectors could benefit if this environment leads to increased Japanese military and security spending. For the yen, escalating trade wars and geopolitical tensions typically drive safe haven flows, so I would expect the yen to appreciate against both the dollar and the yuan if tensions continue to rise and a geopolitical risk premium builds. And for JGBs, you'd likely see downward pressure on yields as risk-off sentiment supports duration demand. The 10-year yield could compress meaningfully on flight to safety flows if this escalates further.
And what's the key watch point here for investors monitoring this situation?
The critical question is whether China's stated openness to talks leads to an actual US-China negotiation and potential deal, or whether the Trump administration expands the pressure campaign to include Japan and other US allies more directly. If it's the latter, that would materially increase hedging demand across Japanese assets and likely lead to a sustained period of elevated volatility. So investors should be watching not just the US-China bilateral rhetoric, but also any signals that Japan is being asked to make concrete policy or trade concessions as part of this broader pressure campaign.
That makes sense. Staying with the broader market themes, it sounds like even though markets were closed today, the key narratives for investors are around foreign institutional positioning in Japanese financials, some vulnerability in the brokerage sector, and this ongoing geopolitical risk premium related to US-China tensions.
Exactly. I think when markets reopen tomorrow, investors will be watching to see if foreign flows into names like MUFG continue, which would support the financial sector and potentially provide leadership for the broader market. At the same time, we need to monitor whether the weakness we saw in Nomura was just daily noise or the beginning of a broader derating in Japanese financials. And then overarching all of that is the geopolitical risk story, which has the potential to drive safe haven flows into the yen and JGBs while creating headwinds for export-oriented equities. It's a mixed picture, but the key is to watch how these narratives evolve over the next few trading sessions.
And from a portfolio positioning standpoint, what would you be focused on?
I'd be looking at whether the financial sector can hold its recent gains and attract continued foreign interest, because that would be a positive signal for the broader TOPIX. I'd also be watching yen levels closely, because if we see sustained appreciation driven by geopolitical risk, that becomes a headwind for the export-heavy Nikkei 225. And on the rate side, I'd be monitoring whether JGB yields continue to compress, which would tell us that investors are pricing in either a risk-off environment or a delay in any further Bank of Japan policy normalization. Those are the key moving parts to watch.
Really helpful perspective. So to recap for our global investor audience, even with markets closed today, we've seen some important signals. Foreign institutional interest in Japanese mega banks continues, there's been some stock-specific pressure on major brokerages, and the US-China trade tension narrative is creating both risks and opportunities depending on sector exposure. When Tokyo reopens tomorrow, those will be the themes driving price action.
That's exactly right. And I think the key takeaway for global investors is that Japan remains at the intersection of some very significant macro and geopolitical forces right now. The good news is that we're seeing continued foreign interest in core Japanese financial names, which suggests confidence in the fundamentals. The risk is that geopolitical developments could create volatility and sector rotation that requires active management. So staying on top of these narratives is critical.